The whispers of a housing crash are getting louder, and the echoes of 2008 send chills down the spine of the market. House prices are getting more expensive, and while we're not building enough homes to meet demand, the available ones face challenges in finding people to own them. But why are some experts suggesting that what's on the horizon might be even more alarming? Let's unravel the threads of data and expert forecasts to understand why this isn't just another market fluctuation. It's a warning sign of something far deeper. Mortgage rates have catapulted to nearly 7.5%. The Census Bureau dropped a jaw-dropping figure. The average sale price of homes in the US is nearly $500,000, meaning it's almost doubled the cost of homes at the time that the housing bubble burst in 2008. Besides that, things might be going wrong faster than anyone thought. There are signs that suggest house prices might drop a lot, even more than some people warned about. Not many people want to buy homes now because mortgage rates are higher, going past 6% for the first time since 2008. Sales have gone down by almost 20% compared to last year, as the National Association of Realtors tell us. However, looking at the housing crash that happened 16 years ago, most things seem better now, except for one big problem: affordability. So while houses and general stuff for people are doing better now, it's more challenging for someone trying to buy a home. Affordability is not as good as it was in 2006, right before the big crash. And while this is happening, the supply of houses visibly outweighs the demand. We've got a 10.4 month supply of new houses sitting empty, the most since 2009, and building more homes than there are families to fill them. Yet the most startling among all these is the price to income ratios on these houses. So doing the math behind buying any houses these days, the result seems shady. So check this out. The average cost of a new home is around $438,000. Now let's pair this up with how much folks earn on average per hour. Estimated at $27.32, and boom, we get a wild ratio of $16,035. To break it down, that's the highest it's been since the gloomy days of the Great Recession. You can see that home prices are beyond reach for a majority of working Americans. So what's the thought here? Now, if home prices don't take a step back, it's doubtful that more people will be able to buy houses. It's like a seesaw. For the demand to go up, the prices need to come down. Moreover, the real estate market, which was sizzling hot for the past few years, is now taking a bit of a breather. So, are we in for a slowdown or a rebound? Definitely this time, it's taking a darker turn than what happened in 2008. But that's not all. The rent of houses also took an upsurge in value. From just last year till now, the rent prices are up almost 30%, and this is primarily attributed to single-family rentals. Also, from January to September, house rents were surprisingly steady for all types and sizes of homes. Now, usually in October, rents start to drop, and this is happening again this year. Even November, rents kept going down for all the different types of homes that we looked at. Interestingly, this year rents didn't go as high as they usually do, but they still follow the usual patterns of going down in November. However, the writing's on the wall. With sales slipping and the rent costs surging, affordability is at a tipping point. But it's not just about the numbers, it's about the stories, the families, the first-time buyers, the dreams on hold. Goldman Sachs analysts are striking the alarm bell, indicating we might be on the cusp of a collapse potentially more severe than the cataclysmic crash we've remembered too well. Remember the bubble back in 2008? Now imagine that scenario with prices doubled. But it's the real estate market's pulse that is truly signaling distress. The S&P CoreLogic Case-Shiller Index, our property price thermometer, has decelerated. A measure of prices in 20 big cities showed a slower increase in July, dropping to 15.8%. And the Zillow Home Value Index, still higher than last year, took a dip for the first time since 2012. But there's more. Big-name cities like Seattle, San Francisco, and San Diego saw their home values drop between 4% and 5% in July. Meanwhile, housing inventory is making a comeback. In fact, in July this year, the housing supply hasn't been this high since the peak of the 2008 housing crisis. Some homeowners might be hitting the panic button, selling their homes in a hurry to avoid losing value. It's basic economics. Too many homes for sale and insufficient buyers can lead to falling prices. However, not all is doom and gloom. Here's Jerome Powell from the Fed discussing a difficult housing correction. And despite the turmoil, let's not overlook a key detail. Many homeowners today are still equity rich, a stark contrast to the pre-2008 circumstances. According to data from Adam, nearly half of the mortgaged homes in the US are equity rich. That means the estimated value of loans on these homes is at or below 50% of what these homes are worth. But flashback to 2009, almost a quarter of US homeowners were in a financial deep dive, owing more on their mortgages than their homes were worth. Now, the latest stats show that in Q2 2023, homeowners saw their equity slip by 1.7%, losing an average of $8,700 between Q1 and Q2. But don't hit the panic button just yet. The National Association of Realtors reveals that the average homeowner has accumulated over $100,000 in net worth since 2019. So here's the bottom line. Today's market reflects tighter lending standards and an abundance of fixed-rate mortgages, factors that experts believe could cushion a full-blown crash. So what does this mean for you? For homeowners and buyers, is this the moment of the crash or just a serious market cool-off? You see, the COVID-19 pandemic did not slow home prices at all. During the first 2 years of COVID-19, the Federal Reserve pulled out all the stops. They dropped their benchmark rate to zero and flooded the market with money for mortgage-backed securities. What happened next? A housing frenzy. With record low mortgage rates and a sudden urge to escape crowded cities, home prices skyrocketed by 40% from before the pandemic. But just when everyone thought they had it figured out, inflation joined the party. The Fed, in response, decided to shake things up and raise rates. Now, in a usual story, that would mean home prices take a dip, but not in this tale. Instead, homes became even more expensive. But the current market is marching to its beat, and it's facing an even more severe shortage of homes than during the Great Recession of 2008. Recent studies have shown that rising house prices have varied impacts on homeowners and non-owners. For homeowners, increased equity might lead to expanding families, while those looking to own their first home may hesitate as their dreams become pricier. Interestingly, a $10,000 rise in home prices correlates with a 5% increase in fertility rates among those who already own homes. It's a different story for non-owners, where the same price increase could lead to a 2.4% decrease in birth rates. As renowned Moody economist Mark Zandi points out, we might be looking at a price correction, not a full nosedive, provided the economy skirts around full recession. Today we've got homeowners sitting on piles of home equity. It's like having a treasure chest in their living rooms. If prices take a dip, no worries, because unlike the last crisis, most won't be underwater. The good news continues. Not many folks are falling behind on their mortgage payments right now. Fewer missed payments mean fewer foreclosures and less chaos in the housing world. But buying a home has become a bit of a daydream for some folks. The prices are hard to get, even with all the equity floating around. So as a homeowner, whether you're thinking of buying, selling, or simply staying put, the decisions you make today are tinted with a spectrum of socio-economic factors that were less pronounced a few years ago. It's not just about interest rates and possible economic troubles. It's a big deal for everyone, from regular folks to savvy real estate investors. Now, for homeowners, when interest rates go up, those with adjustable rate mortgages or anyone thinking of refinancing might face a challenge. Why? Because higher rates mean higher monthly mortgage payments, and that could spell trouble. We're talking about the possibility of more foreclosures and suddenly homes flooding the market with price tags hitting rock bottom. Remember, no matter the market conditions, your home is more than just an investment. It's the backdrop to your life. Remember to subscribe to our channel if you found this content valuable. We'll see you in the next one.